Welcome to It's Personal Finance Canada. I'm Christine Conway.
And I'm Cameron Conway.
And this podcast is a very personal look at personal finance in Canada. Welcome to It's Personal Finance Canada. I'm Christine Conway here with Cameron Conway. And if you're in BC, Alberta, Saskatchewan, Manitoba, Ontario, or the Yukon, and you'd like help with your personal finance needs, investments, or insurance, feel free to find us at braunfinancial.com. This week, we are going to talk to our local resident big brain around here, the decision maker who puts together a lot of our portfolios, does the back end research on the funds, and really is the great mind that makes the whole thing run. If you know anything about our practice, I typically focus on the financial planning side, and Cameron is our investment selector. And he is the one that is digging through the news on a regular basis, having the panic attacks, taking what he's learned, and then using it to create a portfolio that benefits you as a client.
Yeah, that's sort of like my very short job description on top of a whole bunch of other back-end things I get done. But yeah, so we want to kind of close out our RSP season, and we want to talk about the humble 60-40 portfolio. Is it a good idea? Is it a bad idea? Why does everyone use it? And is it actually viable?
Is it dead? I mean, a few years ago when we were going through COVID, there was a big push in the media saying 60-40 does not work anymore. You don't want this. And if you've been doing this for years, what the heck have you been doing? So why don't we back up a little bit? And Cam, why don't you explain to us what a 60-40 portfolio is and why someone might choose to have it?
Yeah, so the easiest way to look at it is 60-40 represents the ratio between how much equity, which is like stocks and companies, and how much fixed income, which is essentially debt in companies. So 60-40 means that 60% of his portfolio is invested in the stock market in companies directly, trying to get dividends and capital appreciation, and 40% of your portfolio is invested in government bonds, corporate bonds, and other kinds of debt vehicles to hopefully smooth out the ride from the equities a little bit.
So who would use a 60-40 portfolio? What risk profile would you say would be attracted to a portfolio like this?
Well, according to some of the stats, it's almost everyone. It just seems to be like the number one picked. You are a balanced investor. You answered your 2 or 3 page risk tolerance questionnaire and you chose balanced.
Well, and it's funny too, because as we kind of move into the world where more and more online robo-advisors are being used and more ETFs are being used and selected, a lot of these online portfolio managers, they will have their risk tolerance questionnaire, and depending on how you answer their questions, you get automatically slotted into a version of an equity to fixed income mix that is in line with that tolerance. And you got very, very little you can do about it, right? Like if you don't like the answers, I think some of them give you like one do-over, but beyond that, it's basically how you've answered the questions about how you feel about how the market moves up and down, your propensity to handle a loss, and your timeline can be important factors in picking this type of portfolio versus a different portfolio.
Yeah, and anyone who has bought a mutual fund or a segregated fund has come face first with the risk tolerance questionnaire. And yeah, like the one we use, it kind of breaks people down into like 5 categories between it is just like 100% fixed income all the way up to you don't care about fixed income. You just want 100% equity and just kind of everything in between. But a lot of people default to 60-40. But then again, like we've got like Modern Advisor and Nest Wealth, and I think they've got like 9 or 10 different risk categories, depending on how you answer the questions. But it's essentially the same thing. It is seeing if you are actually comfortable with the long-term ramifications if you pick this risk category and it doesn't go to plan.
Well, and I think that a lot of people out there, people that have a propensity for DIY, will argue, why not just be 100% equity?
Because if you DIY, you can't sue yourself.
Yeah, I should be 100% equity. My grandma should be 100% equity. My
you
dog
can't
and
complain
cat.
to the regulator if it's your own bad decision. You can try. People have tried.
Oh my goodness. It's true. But maybe this conversation is to say that certain types of portfolios or certain stages of portfolio composition or even withdrawal, if you need money now versus if you don't, can play a role in whether a risk tolerance questionnaire or a risk tolerance profile is appropriate for you. Because yes, there is absolutely that conversation that says that you can do very little. Okay, maybe not very little, but it's minimal the damage that you can do during the accumulation phase. It's during the decumulation phase where you can really, really, really hurt a portfolio if you've allocated it incorrectly. But of course, to do well in the decumulation phase, you have to have made a lot of money, right? Or maximized how much you can get ready for that retirement event.
Well, even with our own clients at Braun, it's kind of 60-40 in accumulation, it's 60-40 in decumulation. Some people might go 80-20 decumulation, but it's kind of within that same band. And what we want to do today is essentially just talk about what the 60 and the 40 mean, what to look out for when you are picking your own funds, either segregated funds, mutual funds, or if someone else is talking to you about it, just so you know what is kind of being put into this and just, what's 60? What does that do? What's the 40? What does that do? And how to be better informed on how to make those decisions when you start picking between funds A through B, 1 through 500 or more, which is what we've got.
It's what we do on the regular. But I will say too, someone's stage in life can determine how that equity component is composed. So not everybody will get the same equity mix. And that's where I think the value of advice comes into play, where someone who's asked you questions, who understands your circumstance, might be able to narrow down the equity portion a little bit better than a robo online or something like that, where it's auto put into XYZ or ETF ABCD.
Okay, so let's get into it. And we're actually going to talk about the 40 first. We're going to talk about fixed income first. Well, for one reason, make sure you stay till the end to talk about equity, which is where all the fun is. But really, fixed income can be actually the more interesting. Like, we've had some chances to talk to like fixed income portfolio managers, people who used to do the buy and the sell side of it. And most people don't realize that this is actually like one of the biggest parts of the public market. People think, oh, it's like the S&P, the TSX. Those are like the biggest things available to us when we're doing trading and investing. But reality, it's actually fixed income, because at its core, fixed income is just a debt trading.
Well, and debt is huge, right? If you think about it on the different levels, you can think about it in terms of a country issuing debt. You can think of it in terms of a company issuing debt, or you can think of it as like your aunt, your uncle, your grandma issuing debt to you, whether or not that's in a formal agreement or not. You wouldn't buy that on the open market. But the point is, yes, fixed income is the hardest job to do and often underappreciated because the narrow margins, right? It can be a lot more difficult to make money, but this really is one of these things that makes the world go round.
Yeah, so when we look at fixed income, there's really two big categories to look at. We've got the government side and we've got the corporate side. Yeah, and I guess another big difference kind of between like fixed income and equity market, it's actually a lot harder for the average person to go out and buy these bonds. There's a bit more flexibility now, but you have to do it like through an ETF or a mutual fund or a segregated fund. This is very much like an institutional dominated part of the market that we get to kind of play in through other types of funds.
Yeah, so if the average person is wanting to buy a bond, you're right, it's more common that they will buy a bond fund. And if they're wanting to buy an individual issue, I mean, man, oh man, like the government of Canada, like those old Canada bonds, those seem to be a thing of the past, right? But that is kind of the throwback to the individual side of it that used to exist.
Yeah, because some things are sold through investment banks, they're sold through regular banks. It could be credit notes, it could be long-term debt. There's just a whole host of different options. But yeah, the average person, you are getting it through a fund or a very, very specific ETF. So let's kind of get into a couple of the big differences when we look at fixed income. The two really big dividers are whether it is a government issue or it is a corporate issue. So a government issue is pretty self-explanatory. This is issued by a government, generally in its own home currency. There are exemptions or exceptions. You could have like Euro bonds where you've got like one country is trying to sell up bonds in US dollars, but for the most part, you are buying the currency of a government. Most often or not, we tend to buy our own in Canada, or you have the US, like their 10-year treasury note is kind of like a standard benchmark used. But this is the government saying we will take money from you today with the promise that we'll give you a certain amount every single 6 months, and then we'll give you your principal back at the end. So this could be 1 year, 5 year, 7 year, 20 year, or 30 year. And the same applies on the corporate side. It could be a different staggering of how long it is, but it's the same idea. Every 6 months or so, it is going to pay a coupon, which is essentially just the interest payment to have your money go to work for them. So when you're looking at fixed income, you could see like a coupon rating or a yield to maturity. Difference between the two is that yield to maturity is essentially what you would make if you collected every single one of those coupons and reinvested it in that exact same bond. This gets a little bit messy when you're looking at funds, but the yield to maturity is sort of the same thing.
Well, and bonds can get actively traded, which is another wrinkle in there as well. But before we move on, I think it's also helpful to put it out there that people look at government bonds as being kind of the safest bond out there. Of course, depending on who the government is, who the issuer is, that's one of the things that you're going to want to consider when you're picking a bond fund is what is the likelihood that I will not only collect all of these coupons that I'm agreeing to, but also that I'll get my money back at the point in time when this is matured. And one of the risks with corporate bonds, if you're not picking the company that is issuing the debt correctly, is that there is a potential for default, where that particular corporation can say, you know what, nope, we can't pay this particular, and then shut it down, right? Now that, of course, is a very, very, very unlikely scenario, but it is something, especially if you're looking in that higher yield space, that can actually be part of the conversation of, do I want to purchase this bond that might pay me a little bit more, but it has a higher risk of not being completed?
Yeah, and this is why people will get a higher coupon out of corporate bonds for the most part, because there is that extra risk. So the way it's usually priced out, it is they'll take like the spot and the futures pricing of like a government bond, and then they'll add on a risk premium on top of it. So you could have like a government bond with a coupon of like 3.5%, and then all of a sudden you'll have like this corporate bond paying like 5 or 5.5%. Is because they have to pay more to get people to give them that principal amount so they can go out and do their capital expenditures. Because if they try to offer the same coupon rate as a completely risk-free government bond, no one would buy their bond, or they would buy it and just dump it really quickly. So there has to be that risk premium on top of it, which is why you'll see corporate bonds have a higher rating. And this also varies on the credit quality of the corporation itself. So the way bonds are rated is usually from like a single B all the way to triple A, but sort of that best performing is in that AAA to triple B rating. So this is like the relatively safe investment grade, and then everything like double B and below is like there is a decent risk that you might not get your money back, or there could be a default, or there's something systematic wrong with the company. So instead of getting 5.5%, they might offer like 7, 8, or 9% coupon, because there is that slim chance that you might not get the principal back. So you want as much as you can. And again, because all the stuff is rounded up into funds, it's up to those fund managers to do their Macaulay duration math and figure out how long do I hold this bond for to kind of maximize the risk to return to default ratios.
So you're saying you do not want to see a D in any of the ratings?
You can't. You can only see a B. Well, it depends on the rating agency. Some go down to D, which D is for default, but some rating agencies will just go down to a single B, which is essentially the same, but this will very most likely default.
So to kind of sum it up, a bond is essentially just a company or a government saying, we need to raise some capital. And the way we're going to raise that capital is to go out to the world of institutional investors and say, hey, we have an offering for you. Please give us some money, the money that we're requesting, which is going to be determined by the total amount of the offering. And in exchange, we are giving you a promise to pay, and to sweeten the pot, we're going to give you these coupons or these interest payments along the way. Does that kind of sum it up?
Yeah, so like a corporation can say, like, we want to raise $8 billion in debt. So they send this out in like $1,000 units. And then, yeah, we say every 6 months, we'll give you this coupon rate. And then at the end of like the 10 years, we'll give you your final coupon and your money back. And hopefully they did something with the money to make the money back and actually grow their company. But even then, there is just so much flexibility. This is why fixed income gets so complicated. Like even on the corporate side, you could have secured notes, you could have unsecured notes, you have a convertible convertible. So unsecured, that's usually like a big company that says, oh, we're not putting any collateral up. You just trust us. Or like a mid-sized company will have the secure, like we'll put up some collateral, we'll give up some voting rights, or we'll let whichever major institution has the most of our bonds dictate our policy. Or you've got convertible, which is essentially that if we don't fully pay you back to your full satisfaction, just convert it into stock, and maybe that might be worth more.
Well, and that's an interesting point as well. When you buy a debt issue, when you buy a fixed income product, you are not necessarily buying into that company in the same way that you are with equity. With equity, you're buying a share or a unit in a fund that holds shares or holds little pieces of corporations that would allow you to maybe participate in the capital project that we've been raising all these funds for, right? But in the sense that you're just buying your bond fund, you're saying, I don't want market risk with this portion of my money. So I don't care how the underlying company does. All I care about is that they're solvent enough to be able to continue to meet this obligation that they've agreed to pay me as the bondholder.
Yeah, and this is why people use fixed income as sort of that counterbalance in their portfolio. This is why it is that 40. Like one way to look at it could be that you want your fixed income to essentially keep up with inflation as these coupons are being paid out every 6 months or so, or every year, depending on it. But it is just this understanding that if the stock market goes up and down, these companies hopefully are still solvent enough to essentially pay their bills to the bondholder. So this is where fixed income is supposed to give you that layer of security, but it's not always guaranteed. Like we saw in 2022, 2023, where bonds and equities were both kind of in the red for the year. But the overall picture of fixed income is it is supposed to give a bit of stability. It's supposed to give a bit of inflation protection on a year-to-year thing where there could be some drops in the equity market, and just make sure you're getting just a few percentage points just to kind of keep up with everything else.
Well, and as a counterbalance, it can be a safe place to go within your portfolio if you hold both and the market is down, the stock market is down, and you still need some quick cash. In theory, your bond fund is still up because it's not tied to the market in the same way. So you could, again, in theory, it doesn't always, as Cam explained, play out that way, but more often than not, it's still a part of your portfolio that you can access when you may not want to sell units in a fund that holds equity.
Yeah, so when it comes to kind of building these 60-40 portfolios, you kind of have like two options. You can either just do the all-in-one balanced fund where it just does it all for you, or some people will just pick some equity funds, pick some bond funds, and mash it all together. That's essentially what my job is at Braun. We've got a good handful of like pre-mixed, balanced portfolios, but I have more fun kind of mixing it together where I can have that flexibility where I can pull a bit more from this fixed income or offset with that equity, where a lot of people, they'll just essentially go to their bank, fill out the risk tolerance questionnaire, and you either pick the two balanced funds that are available or more. But I've seen some banks where it's just two. But then it can get fancy. Is it a tactical balance fund? Is it a fundamental? And just this whole other thing where it's essentially just a 60-40, and it's up to the portfolio manager to determine how they're going to kind of balance everything out against each other and still get you your 4, 5, 6, 7% year over year balance fund kind of normal return.
Well, and to pump Cam up a little bit too, when he does his comparisons, his portfolios that he builds usually tend to outperform some of the stock stuff that we get pre-made from the companies that we do business with. So very cool in terms of the picking, and very, very cool in terms of when you have the right comparison tools and you understand portfolio composition, and especially how the equity side of it works, you can actually build something pretty neat for different people at different stages in their lives. So why don't we transition over to the equity side of it? This is where it starts to get exciting, and this is what makes the news and the headlines and what everyone wants to talk about.
Yeah, so equity, this is the 60 side of the 60-40 portfolio. This is the equities. This is all of the stocks that you now have access to through either ETFs, mutual funds, segregated funds, or whatever else you are playing around with today. It is the wide world, which is still technically smaller than the fixed income world, but this is what everyone is looking at when they look at the news or they try to follow companies. This is where a lot of the fun happens, or at least this is where the popular portfolio managers end up, because it's easier to say, oh, I made lineup go 44% this year, as opposed to a bond fund where we say, I made it go up 4%. I didn't destroy everything.
Woohoo! No, but the equity side is where it gets a lot more interesting. And like you said, more media play, more digging into what a CFO is doing, what the manager of the company is doing, what the C-suite is deciding in terms of the direction. This is where you have active portfolio managers that will go downtown, whatever, Toronto or wherever it might be, to the States, meet with the management teams in these different corporate settings and see what they're doing, see what they're working on, and kind of get pitched on why they should put their money with that particular corporation.
Yeah, and with us, because we are dealing with funds, we are trying to kind of play the asset allocation game. And this is what really makes or breaks not just the 60/40 portfolio, but just any portfolio that deals with equities whatsoever. It is figuring out what is that sweet spot of balance between all these different sectors, all these different types of companies, so that you can continually get gains and growth every single year, as opposed to just front loading whatever is hot right now. So like tech, for example, and just hoping that it just does the same job every single year. And it doesn't. I've seen so many charts where it shows like which sector perform the best relative to others every single year. And it's very rare where you'll see like the same sector be the number one performer like more than like 1 year or even 2 years. It just flips around so much. And this is where that big argument for asset allocation comes in. It's making sure you've got little pieces across all these sectors, because you don't actually know what's going to happen this year and what could do great, what could do poorly. And next year it could be the exact opposite, and you may not have been prepared.
Well, and I think a lot of people just want a smooth ride. I mean, yes, of course, they want to make as much money as possible relative to their risk profile, but they're also not wanting any blowouts or any surprises on the negative, right? That whole conversation that we feel losses so much more deeply than we do even the gains. Like we will be far more depressed about a bad choice and a loss than we will elated over a good choice that's made us a lot of money. And sometimes, we kind of normalize these last couple of years that we've had. Oh, I made 20-30%. Yay. Like where's the joy in that, right? But there's a lot going on behind the scenes. So when we're looking at asset allocation, yes, it is fixed income to equity and that composition to give you the smooth ride, but it is also sector selection, like you were alluding to there, Cam, where different parts of the economy at different cycles, different stages in the market cycle perform differently and do different things. So you can't lose sight of where we are in a market cycle, because that can dictate what may or may not be in favor or what may be rotating through in a specific way.
Yeah, and with us at Braun, because we are dealing with segregated funds, it is a lot of minutia, and it is which portfolio manager is managing their asset allocation the best, which ones are just essentially just doing whatever is popular right now, which could get them some short-term gains, but it could hurt them on the long term. And we actually use this to filter like which companies we work with. So we're contracted with like 8 or 9 different insurance carriers that have segregated funds, but we do the bulk of our business with 3. Just because of just a good track record, or they're doing a certain role that we need to be done for our clients. But this is what we're looking at as how are they managing the asset allocation? How are they trying to get the gains that they can this year without putting too much risk on the books? And this is where I start digging into like standard deviation and all the risk metrics to see, yeah, this guy did really good this year, but these 3 or 4 years, they underperformed everyone else. They had a higher drawdown. And it's coming to the understanding that you actually have to balance this stuff up. You have to balance your balanced portfolio, so to speak. So you are trying to pull as much from the entire market as possible to kind of get those consistent year over year gains. Because a lot of people with retirement, you are playing a 20 or 30, 40 year game here to get ready for retirement. And we haven't even got into like geography and all the other kind of stuff, which is another way to add diversification and to mitigate risk and to hopefully smooth out the ride without putting all your eggs in one basket.
So diversification can really essentially just be a lot about risk mitigation. So do you want to tell us a little bit about how you look at that?
Yeah, so I know for a long time, like the big idea was you just throw more funds, just throw more companies, just throw more and more into the bucket and diversify away everything. But On paper, yeah, you're trying to add more variety to lower your overall risk. But at the same time, we don't see mutual funds and segregated funds with like 1 to 2,000 holdings as much anymore. It's actually pretty rare, where 20 years ago, that was the big thing. If I just put 2,000 companies into this mutual fund, it'll just do good enough. And yeah, that meets like the diversification, but it can be overloaded to the point where you get absolutely no growth whatsoever. So this is why when we're looking at funds and portfolio managers, we're tracking to see who is actually matching a good like standard deviation, a good risk metric, without going overkill just for the sake of just throwing more stuff in for no reason. Because you do need the sector balancing, the sector diversification, the geography balancing and diversification, all the stuff working together, but without going overkill to the point where you just take away any possibility for growth whatsoever.
Well, absolutely. I know one of the things that we try and weed out are those closet indexers, right? People that are building a portfolio, fund managers that are building a portfolio that looks so much like its benchmark that what was the point? You might as well just have bought the benchmark in that instance. And actually, some of my favorite funds are what they call high conviction funds that might have a significantly lower number of very carefully selected stocks in it to fulfill a particular mandate. And it's always really, really important too to look at what the fund that you're picking is capable of doing, because a lot of funds will have parameters that they have to work within. So I need to have X percentage in this, or I can't exceed X. And they can have all these other rules and regulations that the portfolio managers are bound by, but until you kind of read the fine print, you might not know what those limitations are. And in some market instances, you like that, but in other market instances, you want it to be wide open, where the fund manager has full discretion to, within the mandate of that fund, do whatever they feel is necessary.
Yeah, this is how you have like Canadian equity funds with like 10 to 20% US content in it, because there is that bit of wiggle room.
Or even 30%, right? Like we've seen some where they're trying to get extra yield and they're going outside of their mandate. So yeah, Canadian balanced is not exactly Canadian balanced anymore. You have to actually lift up the hood, look and see what's underneath to see what your composition is in the actual holdings within that.
Yeah, so we've talked a lot about 60-40 portfolios today, but I guess kind of the big question is this still viable, or is this just the easy option that everyone just tends to pick?
You know what? I think it's a good option. I think that depending on where you fall on the risk profile, that will be the big determining factor of how much equity to how much fixed income content you should have in your particular portfolio. And I will also say that some people have different risk profiles for different goals that they're trying to accomplish. So one may be high and another may be low if it's shorter term in nature. And it's not really, I think the 60-40 was designed to kind of be a one size fits all. It doesn't have to be that. And you can actually, as Cam has kind of described today, have a lot of room to play on both the equity side and the fixed income side in composition, even if you're building something as standard as a 60-40 portfolio. So that's how we saw the 60-40 portfolio at Braun Financial. Is it dead? No, I don't think so. I think it's still got...
Regulators won't let it die. You are bound to your risk tolerance questionnaire.
It's true. And like I said, the value of advice and of a good financial planner is they will really help you get into the nitty gritty, all of the detail. That's why you're paying someone to get into it. You're not just getting the stock one ticket solution that you get at a bank or something like that fits their KYP requirements nice and tidy. There's a little bit more that can be done to kind of try and get little bits of yield out of these things. So if you'd like someone to take a look at your portfolio, or if you'd like that second opinion, feel free to find us at Braun Financial, braunfinancial.com. And until next time, take care.
And all the best.